welcome to the third class in the Finance Lab 4125. We'll be talking about capital budgeting and valuation. As always, let's look at where we are in the syllabus. So we've covered capital structure and dividend policy so far. And today, it's a basic class. There's basically two sections to it. There's project valuation. We'll cover three methodologies. And then we'll talk about real options, which is a topic in its own. Let me just kind of give you a little bit of foundation, and I'm sure none of it will be new to you, but just to level set. There's basically two main things in capital budgeting. First is estimating free cash flows. In today's class, the free cash flows will be given to us. It's a big exercise in practice, and but it's very case by case, very specific to each situation. On the other hand, discount rate is something that we will extensively cover today, and that's something that's good for discussion in class. To calculate present value of cash flows, we'll use three methodologies. WACC method, which is pretty typical standard method, most widely used. In addition, we'll talk about adjusted net present value and flow to equity. I'll give you a quick introduction here into WACC methodology. Again, probably most standard. You'll talk a lot about it in this and other classes. But let me give you a quick refresher, and then we'll dive into the case, and I'll then turn back the slides and we'll talk about the other methodologies a little bit later. So the same kind of approach, we need cash flows to present value. We need to calculate weighted average cost of capital. And then we basically discount cash flows using weighted average cost of capital. The formula for weighted average cost of capital should be pretty familiar to you, but here it is just for your reference. We'll talk about each specific component, where we get it. We'll find components and calculate the WACC for Toyota together. But let me remind you very quickly how we calculate cost of equity. So in this, when we actually go and find information, we'll need to have equity amount and debt amount. So for equity, we'll calculate it as share price times number of shares, and debt we'll take from the balance sheet. So we'll go to FactSet and download balance sheet and income statements. Income statements we will need to calculate the tax rate. And the formula we will use is income tax from income statement divided by pre-tax income. For cost of equity, I haven't given you a formula. We'll just take the yield to maturity on the shortest duration U.S. denominated debt for Toyota. So we'll find that on FactSet. Well, let's jump into the case and review it together. Let's pause here and go to FactSet. You know, the steps here are pretty well described. So let's go. I'm using web-based version of FactSet. So you can type Toyota Motor Corporation. It'll give you numerical ticker. You know, this example is a little bit unique in the sense that you're using a foreign stock, but I guess it's relevant because Toyota is located in Dallas. So I'm glad the textbook is using that example because you know, some of you may go actually in the work for Toyota, even though they're an international company. But you know, it'll create a little bit of a complexity for us because you know, as you can see on my screen here, their share price, for example, is denominated in yen. But let's use dollar-denominated information as much as we can. So we'll have to pay attention to currency. So in step 1A, we need to go to financials and find income statement. Here, just a couple of things for you to pay attention to. In settings, it's a dollar-denominated income statement, so it's US dollars for currency. For periods, I'm using fiscal years, just so that you have same periods. We'll be using 3 or 4 years in our analysis. Let's download it. So I have a template open. You can find that on Canvas. So you see, template is just one tab with column B populated with headings. So let me add a separate tab. I'll call it, let me just call it income statement IS. And then I will go to this file that we downloaded from FactSet, and I'll just select it and I'll copy information into my tab. If you're curious, I'm switching between these screens here using Alt Tab. function. And then in next step, we will need balance sheet. So I'll create a tab for balance sheet. So let's go to our instructions and see what they tell us. Select balance sheets and repeat download procedure for balance sheets. So same thing, pretty straightforward. So I'll press on this green down arrow button, click download, wait for the file to appear on my screen. And then I'll copy and paste it in Excel. Pay attention to the column headings and the time periods from which you have information. Like if you have it slightly different, set up slightly differently, you could have different time periods, but I'm looking for 3 or 4 years. So I've kind of preset it, but if you have slightly different settings, make sure that they are the same for you. Do a download and do it again. Okay, there it is. I'll select it. To select, I'm keeping Shift pressed, and then I'm going to the right with arrows or going down. And then to copy and paste, I'm pressing Control C, and then Alt Tab to switch to your file, the template. And then there, I'm pressing Control V to paste it. I'll double click on column B to expand it. Let's see, under 1C, we need some historical prices. So the place to put in the historical prices would be right in the first line of our template. And pay attention to the units here. So it says all numbers except per share data are in millions. So for the share price, we will need share prices corresponding to these periods that you've selected. So we'll need to go to prices, price history. What I have preset here, I have US dollars. So my share prices are in US dollars, they're daily. And the period that I've selected here is from 2003 to 2020, so a few years back. We will only need 3 last years. And again, the time period, let me close these downloaded files. I don't need them anymore. So I need share prices as of March 31st, 2020, 2019, and 2018. So March 31st, 2020, the share price was $60.22. I'll close that. Okay, $60.22. March 2019, I need to scroll down. March 29th, the closes date 2019, the price was $58.61. $58.61, and then 1 year earlier, March March 30th, 2018, the price was 64.17. Shares outstanding. This will be a little bit interesting. Typically, you can find that on the overview of any stock. So you can see basic shares and you've got the number there. We will be going back in time and calculate the equity value. So what I'd like to do is get the share count for each of the balance sheet dates. I'll go to balance sheet, and this is kind of a shortcut. There's probably a different way of doing that. But at the bottom of balance sheet, FactSet calculated tangible book value per share. This is as of March 2020. And to calculate the tangible book value per share, they had to use common shares outstanding as of that particular date. So that's where I'll get it from. So as of March 2020, the share count was 2766. Make it blue. And then March 2019, this would be previous, next column to the right. So the number is 2832. I'll put that in Excel. And then in 2018, the share count was 2909. So market capitalization, that is just share price times the share count. So we've completed step number 1. Let's look at the instructions for the second step. So we just need to replicate what we have in the data case description. So initial investment was 1.5 billion. I will put it in millions with negative sign up front. And then in year 1, the cash flow expected is 220 million. Growing at 10% in the first 2 years. So I'll use this formula for 2 years, and then starting in year 4, my growth rate will moderate to 5%. Well, that's pretty simple for cash flows, because usually in reality, that is the most time-consuming part. And there's a separate model that would typically go into that. And then in step number 3, we'll have to calculate WACC. Let's look at the detailed instructions for that. Let's go to FactSet, and on the credit analysis, DCS detail, you can see different bonds issued by Toyota. And then you can see whether they're denominated in yen or dollars. And what we're looking for is yield. It looks like it's 64% on this bond maturing in July 2020. So I'll put in 0.064%. So we need to calculate cost of equity using the CAPM methodology. And there's a further instruction for that. So market risk premium, we'll use 4.5%, and we'll need to find the US Treasury bond yield to maturity. So for the Treasury bond, let's go to research. It doesn't look right. Let me see. I think it's a different tab. Not files. Close overlay. Markets. Yeah, that's where it is. So under markets, it's right here on Treasury table. So for 10-year Treasury bond, the mid yield is 0.67, very similar to Toyota itself. 0.67. Beta for Toyota, we can see that right on the overview tab in snapshot. The 52-week beta is 0.97. Market risk premium, we were given 4.5%. So cost of equity using the formula I provided would be risk-free rate plus beta times market risk premium. So about 5%. Okay, next step in the instructions. Net debt is debt minus cash. I will find that on the balance sheet. So that would be short-term debt plus long-term debt minus cash. The amounts that we downloaded are in billions, so I will need to multiply them by 1,000. And then I can just copy the formula to the right. So that gives me a net debt amount. We've calculated equity as market cap in step number 1. So the enterprise value would be net debt plus equity. And the ratio would be net debt divided by the enterprise value. So the target debt to value would be the average of the 3 years. I think the instruction says 4, but I've only kind of populated 3 years here, so I'll use 3 years. Tax rate, it would be from the income statement. Here, the first column C is called LTM, last 12 months. I'm not going to use it. I'll just delete it so I'm not confused. And then I'll just add a line here called tax rate. So that will be income taxes divided by net income plus income tax. So pre-tax, so it would be tax divided by pre-tax income. So 24% going down to 16 in 2018. So the tax rate that I will select would be average of tax rates for last 3 years, 21.82%. So the WACC itself, see our instructions here. We kind of went ahead a little bit, calculated the tax rates. So WACC would be cost of debt. So start with debt times weight of debt, which is this target debt to value, times 1 minus the tax rate, plus cost of equity times 1 minus weight of debt. So it's 3%, 307. For net present value, quickly look at the instructions. For NPV, we will use NPV formula in Excel. NPV. I'll take, so first the rate would be WACC that we just calculated. For the cash flows, I'll take the positive cash flows in year 1 through 10, and then I'll add my first cash flow. So that'll be my NPV calculation. So the next step is to use adjusted present value method. Let's talk a little bit about what it is. I'll have a couple slides here, and then we'll jump back into Excel. So this is a valuation to the methodology to determine the levered value of investment. And we basically calculate unlevered value separate from the value of the tax shield, and then we add them up to calculate the levered value. So the first step is to calculate the value of free cash flows using the project's cost as if it was financed without leverage. And for that, we'll basically use pre-tax WACC. So the formula here in the middle of this page is similar to what we had before, except that cost of debt is not tax affected. For the value of the interest rate shield, we need to introduce this concept of debt capacity. So it is, and that concept is based on levered value formula that you see at the bottom. So it basically looks at the remaining free cash flows in each year, and the present value of those remaining cash flows multiplied, so we call it VL. So the value of those remaining cash flows multiplied by the target debt ratio gives you the debt capacity. And then basically that becomes kind of this quasi debt that we use to calculate the interest expense. So we apply interest rate to the value of this debt capacity to calculate interest paid in each year. And then we multiply it by tax rate and get the tax shield, and the present value of that tax shield is added to the unlevered value in the final step. So let's do that together in Excel. Step number 5, pre-tax WACC. It would be very similar to the WACC we just calculated. So we'll start with cost of debt times weight of debt plus cost of equity times 1 minus weight of debt. That gives us weight of equity. This corporate format here. So pre-tax WACC is 3.13%. Unlevered value, I'll calculate using NPV formula. And here, I'll take this pre-tax WACC, and then I'll take all the positive cash flows, excluding the initial investment. I'll add initial investment in the very last step. So this is probably the most complex part of today's assignment on valuation methodologies. Calculate levered value and debt capacity. And I like to kind of start in the last year. So basically, and so the debt capacity in the last year will be 0. But then in year 9, the formula would be, and then I'll kind of expand the formula. So it will be the value in next year plus cash flow in that final year, next year, and then just present value by 1 year. So this basically accumulates cash flows, and in any given year, it calculates present value or future cash flows in that particular year. So that's what this formula does. So I'll just present value it by 1 year using after-tax WACC. And I can drag this formula all the way to the left. Basically, again, at any given point in time, it gives me the present value of future cash flows after that year. The formula for debt capacity is fairly simple. It's levered value times target debt to value equity ratio. So I'll freeze that cell C31. By pressing F4, I'll copy the formula to the right. And then the interest payments would be the debt capacity times cost of debt. I'll freeze cost of debt. Change the formatting a little bit. Interest tax shield would be the interest payment times tax rate. I'll freeze tax rate. Copy the formula to the right. Present value would be just NPV. Using pre-tax WACC and including all the interest tax shield. So levered value would be tax shield plus unlevered value. And we just need to add the initial investment, which we haven't incorporated in the numbers so far. So you can see in the green cell that we are getting the same answer for adjusted present value methodology as for the WACC methodology. Look at the final step in our exercise. Here we need to calculate free cash flow to firm. So let's calculate first interest payments on a debt, which could be taken at this target debt to enterprise value ratio. So the interest payment in year 1 would be debt capacity in prior year times sorry, we already calculated the interest payment. So it's just the interest payment. Let's take them after tax times 1 minus tax rate. So we already have the interest payments. I'll extend those. Net borrowing would be basically the difference each year. So in the first year, we would go from 0 to full debt capacity. So it's a big inflow. We count that as inflow of cash to equity shareholders. We basically take money from debt holders, but then we count them towards equity holders. But then starting in year 1, we take the balance in year 1 minus balance in year 0, and we see that the debt is being repaid, in the same amount, just over 10 years. Free cash flow to equity would be the regular cash flow from the project minus interest expense. So the equity holders, they have to pay debt holders interest, but then they get the principal from them, and then, they get benefit of time value of money here. So the formula for free cash flow to equity, again, is project cash flow minus interest plus net borrowing. So for NPV formula, we'll use the same approach as we've used before. Let's say NPV at the cost of equity, and that's really the biggest change in this methodology. Instead of WACC, we are using cost of equity, and we'll take all the positive cash flows in the NPV formula plus the initial investment. So that gives us the same amount as in the other two methodologies. So that's the end of this exercise. In this class, we'll cover 2 different topics. So we'll then go into real options, and I look forward to seeing you there in that section.